Ladies and gentlemen of the crypto space, we're live on a Wednesday, January 8th at 11:30 a.m. I get the sense folks need a stream dealing with market content. I get the sense that folks are exhausted, near, or already have capitulated. What is capitulation in the context of investing? So, why is it exhausting? Uncertainty, fear, uncertainty, and doubt for the exhaustive list of the potential considerations. And we've had fear. There's certainly uncertainty. Doubt is always there. Are you right or are you wrong? Now, the story is always different depending on total time participating in the market, someone coming into the market in 2024 compared to 2023, compared to 2022, compared to 2021. You can have very different perspectives on the market. Prices currently are significantly elevated compared to 2022, which is something to always consider. But you're not going to have that unless it's hindsight, or you're not going to be able to consider that perspective unless it's hindsight. So, hindsight affords context, allows you to have multiple perspectives on any particular situation. The only thing that comes to my mind, aside from the fact that I don't have an action that I can take, other than purchasing new investments if there's significant depreciation, is can markets go lower than 2022 bottom? Frankly, from a Bitcoin perspective, and 2024 bottom from an investment perspective. And that seems like an awkward consideration. If you sat through 2022 bottom and 2024 bottom for alts, seems trivial, nonsensical that those kinds of levels could be revisited. And even if they were, there's no action to possibly take. So how do we make sense of this market? That's all that matters, is understanding your situation, the lay of the land. You are, or rather, the better you understand things, the more comfortable you can be and be like, all right, in this context, compared to this day 3 years ago, what's going on? Why is it going on? So we start the new year off with the dollar. It's all about the dollar. It's always about the dollar. And frankly, interest rates, not Fed funds rate. It's really the market set interest rate, which is buy and sell pressure on long duration treasuries, long duration US debt. And that tells us the way the rest of the world is thinking about the price of our debt. And the price of our debt is what creates the currency, the dollar. So that's the tightly coupled relationship between US debt and the US dollar. So the combined pressure, so you get different effects if there's a bifurcation in market activity, meaning like the dollar's going down, but yields are going up or stuff like that. But right now, you got combined effect. You got the dollar going up in value significantly, and you got yields going up on 10 plus year debt. So it's screaming the opinion of the market that folks want to get paid more for the debt, which means, so why does that happen? If they want to get paid more for holding the debt, that means they sell it. They're like, all right, I'm going to do something else with the capital. And by selling it, it drives up the market rate. So when you purchase the debt instrument, this is the effective rate of return. And that dollar at 109, the DXY, the general inspection of the dollar, is wild. We're at and have been at a critical threshold of how does the market respond past a threshold that cannot be breached. Otherwise, if it is, the whole system falls apart, especially Europe and Japan, which is basically the most general expression of the DXY, with every other currency being paired with the yen and the euro. So the dollar at 109 is quite surreal. We'll pull over to the dollar chart. Now, this was a critical level, the 107.35, because of, if we go back in time, it was a nice resistance level back in 1976. And considering that resistance level actually being hit again, literally in October of 23, there's a bit of a confluence to say this level is meaningful, at least from a technical standpoint. And also, you can consider the entire move back in the dot-com era above it as being rejected. So, this level indicates a level of resistance, at least in the context of my inspection and the way I look at the data. We're meaningfully above that level. So, this is a level that clearly expresses there's tension in the system, significant financial tension. Now, you got to remember what's one way to always understand the dollar. It governs capital flow. The relative value of the dollar governs capital flow into and out of markets. Stronger the dollar governs capital flow into the United States. The weaker the dollar can trigger capital outflow. Now, the complexity there is markets are forward looking. So they're trying to get ahead of what the hell's it going to do. That's why people try and look for double tops. They look for directionality change. Now, overall, the market move above that critical level back in August of 22 is quite weak compared to .com. It is significantly weaker than the 80s that are responsible for the Plaza Accords. And now we have a move again above. Any sustained move above here, 110, oh dear, and things are going to roll over. You'll see maybe, an endogenous capital rotation from equities into risk off into the bond market, which will roll over interest rates. Why? That has to do with the psychology of breadth. If the forward-looking inspection of the S&P and Nasdaq is that it's not going to go up at 15% for the year, it'll go up by 4%, 5%, or general weakness. Folks will take their capital elsewhere, and fund managers and financial managers will need to rotate in order to achieve performance expectations. So that's the balance of capital flows within a market. Um, the dollar at this level, as I said, drives capital into the United States, which is obviously going to encourage expatriation of capital outside of everywhere else for it to be available to deploy into the United States. So that means everyone else is fucked any higher in the dollar, and it just gets worse for everyone else. At these levels, my 2 cents is that you got situation rooms, war rooms trying to figure out, are we really going to capitulate the debt situation of everyone? If you roll over China, you roll over any of the major supply chain components, and that just also blows up US economic normalcy. And this is all known and understood, and this is why the Fed has so many damn financial analysts. Not that they have a control over long-term interest rates, which is why Yellen is screaming that fiscal policy is making it difficult to keep the system stable. And this is where the Fed acronyms, their facilities come into play and how they accommodate fiscal policy without adjusting short-term interest rates to keep the system functioning. And that historically was why they created the QA programs. This is in good part why the Fed, or rather the Treasury, is doing buybacks. They're massaging the composition of debt outstanding in order to create a better interest rate profile across the entire yield curve. You know, at these levels, you can only imagine the types of conversations that are going on because, contrary to what people think, they're very smart. They know what they're doing, or at least they're engaging and doing things intentionally to achieve particular outcomes. And you could understand that in terms of the overarching mandate of the Treasury, of the Fed, of Congress, the executive, not judiciary, it's a little different. But the overarching mandate is, um, keep the system functional and prevent the collapse, the financial collapse of things, to keep the rules based order functional, which is the normalcy, or rather the um, maintainable or digestible volatility of relative currency pricing and interest rates. Now, it gets obviously infinitely complicated with endless knock on effects because relative interest rates is also a significant component in the equation. If the yields have collapsed in China and we're paying 4.68% on 10-year US debt, that's a hell of an interest rate spread. And that creates a carry trade. You borrow at China at 1% and you lend to the United States at 4.5%. Oh, shit. Now you got the yen carry trade conversation, except with every other country. And that's what creates the capital flows into the United States, aside from actually just selling, liquidating assets. You're able to take on debt in foreign denomination and funnel it into the United States. That drives up the dollar because if you're got a foreign currency and you want to buy US debt, you're purchasing dollars to buy the US debt. That's obviously just part of the equation. So these are very precarious numbers. 4681, 109, 109. Now, note that this move in the dollar is significantly lower than the previous move, lower high, if it's a high. Now, the only inspection we could possibly make is, consideration of incoming administrative policy. That's something I mentioned before, very emphatically. For it's clearly stated policy. They literally said that's what they want to do. They need a weaker dollar to do it. They said twofold. They want to entrench the dollar as a reserve currency. Great, that's relatively straightforward. And they want a weaker dollar to rebalance capital flows and allow the US to become an exporter. If it's more favorable for other countries to buy goods and services from the United States because of relative currency pricing, there goes manufacturing in the United States, there goes international services, and there goes a booming economy. And it's weird. It's weird because the whole system is fragile at the extremes. Too strong a dollar, the whole system falls apart for certain reasons. Too weak a dollar, the system falls apart for other reasons, which ultimately leads to dollar strength. Ironic, is it? Too weak a dollar just will cause rapid dollar appreciation because that's the end state for the dollar because of the global debt composition. Anywho, I'm not going to dive into other currency pairs, maybe other than the yen, because 158 is getting us precariously close to our previous highs. And we've seen it how many times in 2024? Yentervention. How do you intervene? You sell US government debt for dollars and you buy your currency. The problem is that has a short shelf life. That's akin to a supplement. That supplement biodegrades. It's not a vaccine that has lasting effect. That's short term. That just kicks the can, but it kicks the can for a very short term. 2 weeks, a month, a quarter. So there's nothing sustainable about this dollar pricing. There's nothing sustainable about long-term US debt interest rates. And this leads us to thought experiments. Does the Fed do QE? That is not politically favorable. The political optics on a QE program, oh dear, it's almost a non-starter at this point. Fed expanding their balance sheet? Oh my goodness. I don't know if that can be digested by the politicians, and they could spin it into something reasonable in news media. So there's a quite interesting consideration. So what are the policy tools? We know the executive policy of the incoming administration, but how do they actually do it? Geopolitical collusion, deals. That's essentially what the Plaza Accords were, set of deals to structurally devalue the dollar. Now they clearly don't want like an equities market collapse. The equities market is what drives the vast majority of receipts for Treasury. You get a massive 10, 20, 30, 40% correction in equities. What does that do for morale? What does that do for social civility in an already meaningfully unstable social situation as compared to historic norms? Pretty unstable out there. So, from a political perspective, they probably want to avoid a stock market crash. From an administrative perspective, they want a weaker dollar so they can pursue domestic policy. From an international perspective, they don't want to collapse their allies, and you probably don't even want to collapse your enemies because that just stirs geopolitical conflict and tension. So this is not heading in the direction of anything that anywhere that anyone wants. And this is where you get intervention. So sit back, relax, enjoy the show, because at these levels, shit is going on. And it will get more extreme the higher these levels go from a 10 to 30-year interest rate standpoint, as well as a relative dollar valuation standpoint. Bitcoin's clearly reacting with a degree of weakness. Sailor is buying, buying, buying. We'll see how MicroStrategy's price holds up in the short term. Clearly, the long term, everything he argues from a strategy standpoint makes sense to me. But it's not just him. There's an entire market, an entire world of market participants. And they've managed to drive the price down of Bitcoin below 95,000, which is an extraordinary valuation from what, Q2 2024, even early Q3 2024 ETF launches. You were at 47,000 when the ETFs launched. And ETFs launched and it drove it down to 40,000. And we're at 94,000 with the dollar at 109. You really can't make this shit up. And this is why the market tells the story, because you can never make up this story. It actually has to be the market telling it because it would be surreal otherwise. Dollar at this level. And Nasdaq's in the green. That's crazy. Obviously, anything other than Bitcoin is relatively taking a beating. Bitcoin dominance is nominally down today, which is interesting, which is an expression of relative strength relative to Bitcoin, that is. Overall, we look back a year from now, I say the 100 on the monthly holds for Bitcoin dominance. That was, this is a several month move above the moving average, but I say this holds. Look at the trend. The trend goes back to 22, and clearly it's higher before. It just didn't have enough data to draw. If you go to the weekly, you get different moving averages, so it's not like we could visualize that. But clearly, if you project the trend into history, it was much higher, but the trend is clearly downward. So that is telling us something significant about the structure of crypto markets in relative Bitcoin pricing relative to everything else, or relative valuation, total market cap, stuff like that. This line is actually very meaningful. It tells us other stuff is very significant. Not in the context of Bitcoin as money type argument. No, that's irrelevant. In the context of enterprise, in the context of fintech and business and productive enterprise, things that meaningfully contribute to financial activity. That is clear as day. That line literally says that. It doesn't, there's no writing on it, but that is what that line tells us, that the trend is down and that other assets are increasingly valuable over time relative to the Bitcoin pricing situation, total market cap. And that is fascinating and telling, not for now, not for the short term, but in the midterm, in a quarter, in 3 months from now. Where will things be? So that is the best mindset to have, a future mindset. Druckenmiller talks about 18 months. I literally tell you guys stories about 2028, 2032. And that's what I try and train my mind to think in terms of those long time frames. And that's why we have this whole narrative of owning and investing. And so there's risk in that, but those risks, I've argued, are significantly alleviated by the fact that these are immutable contracts. And that entire conversation we've had over the years, that is very significant to the point where we have to reevaluate what the heck is risk. What the heck is risk over what time frame? Very different equation as compared to equities, which are entirely liquid always. There's no such thing as locking in equities. Market wants to dump, anyone could dump their bag. It's a very different case with these crypto markets. Let's go through commentary. We'll see how long the stream is today. But as always, I'll get to all your questions. If you're on X or YouTube, feel welcome to ask anything. I'm more than happy to talk about anything. Arrow, good morning, my friend. Hope you're well. I know you've talked about the theory of higher lows moving forward, yet despite last bear market having more liquidity in our system compared to prior, coins like Curve and Convex still hit all-time lows. Let's digest this. Higher lows, yeah. So that is something that the market will tell us. Are we going to get back to 20 cents and what, a buck and a quarter on Convex? If we're talking about two particular assets and their pricing, I would say from my own perspective, that seems quite unreasonable. Note very specifically how I use semantics, the definition of words. Unreasonable. What are the odds? What is the likelihood? To me, that seems unreasonable. What were the conditions that created that relative pricing? I don't think those conditions can be achieved again. And that's my belief. More than happy to accept whatever the hell the market tells me is actually occurring. I still hang my hat on immutable contracts and the fact that these are fintech enterprise and price could collapse and then it reinflates because these prices will respond to market conditions in the future. So I care little about the volatility. I care that these investments, these things that I own will continue to exist into the future under all conditions. Contracts will continue to function. And that is what matters most to me. Well, what is stopping Curve from hitting 20 cents? Well, Michael's liquidation and the incoming tsunami of supply, forced selling. Those conditions are gone. There is no forced selling other than what Lamaland or whatever the hell platform is accepting CRV as collateral or forced selling upon a liquidation scenario. Um, but I don't think any of the debt outstanding is even remotely comparable to what we experienced towards the lows in curve pricing. Aside from that, we have a new incoming class of late 2024 and now 2025 narrative. Very different narrative for curve. The incoming class, the new folks, they have no sentimental knowledge of inception of hyperinflationary decay, and they probably arguably don't have any sentimental experience with um, you know the, the the liquidation cascades, the saga of the liquidation cascades, 22, 23, and however long it lasted. So they don't have that bias. How do we know? How do we know this is the case? Look at market sentiment. Look at social media. Those narratives are the prominent narratives now. Maybe most interestingly, the prominent narrative is all roads lead to curve. That is literally what's circulating. And CRVUSD is at $81 million in this particular market in these conditions. If we go over to curve, these numbers look very interesting. These numbers would be very different historically speaking. We're sitting at, if I could click the right thing, $81 million of curve supply with interest rates less than 15% across the board. 10.39% interest, $25 million in S curve deposits in the context of $81 million outstanding. And these are interesting numbers in consideration of where things were. And frankly, independent of where things were, these are interesting numbers, even if you're not considering where we came from. These are literally interesting numbers for this product, this dollar product, especially considering market conditions right now. What more can I possibly say on this point? I appreciate it. Raul, hello. I thought a concept. Good morning, Brian. Happy Wednesday. Sekatsu in the house. Hello, my friend. Hope all is well. But a concept, Cap, I want to take a moment to show my appreciation for how well you have educated me. Your rants is when I learn the most. You're an awesome person. I fully see it and understand. I thank you, and I'm humbled by such words. This was never a stream about talking about tokens or what's popular, what's a good investment. This has always been a stream about me going on a journey and understanding this shit in terms that nobody thinks about, in terms of how I wanted to learn how to think about these markets and what they are, hear through the bullshit and see what really is. So your words are very meaningful to me. Humbled. How else can we do different, behave different, think different if we don't explore narratives that the vast majority doesn't consider? And we sure as hell know that thinking like the vast majority does not lead to success. The vast majority, unfortunately, do not win. There is no popular term over for the last administration was equity. They fight for it maybe at an administrative level, but there's no real equity. Not everyone has the same opportunity. Certainly isn't equality in many regards, especially financial equality. We sure as hell want like personal equality where everyone has a capacity to interact and be rational with one another. And there's nothing else to consider in that regard. Just be a rational person. Talk, converse, present argument, receive response, digest, continue, rinse, repeat type shit. So unfortunately, y- probably the best thing and only thing I could say to that end is you can lead a horse to water, but you cannot make them drink. You could stand at the center of Times Square saying, "You're all thinking about this wrong. There is a better way to think about things. You can do better." It could be the most compelling story in history. And one, you have to hear it. We have a relatively small community, 294 people on the stream right now, which is humbling as always, but it's still something that's a learning process. And it's not a learning process. I'm not educating directly. There's no such thing as direct education. It's a process of assimilation. I speak, I show things, I tell stories. It's up to everyone individually to process it, assimilate it, digest it, incorporate it, and refine it, and then come up with their own stories, which is why I kind of encapsulated dinner table investing. That should be a goal, which is literally what I do on the stream, is being able to actually talk about these things in a rational, coherent way. Hope that helps. Can you explain how interest rates are affected on Curve USD? I know people's on Curve. I don't fully understand it yet, so I can explain it to folks. So this has to do with PEG. So if you're borrowing CRVUSD, you're minting CRVUSD out of nothingness. You're creating a liability. You're borrowing it. Why? Because you want to buy something with it. When you buy something with a dollar, you're literally depreciating the dollar and you're appreciating that thing you're buying. So if you're selling a CRVUSD, you're causing it to depreciate in value and you're going to buy something and that's going to go up in value. Everything's relative. So there's two components to a stablecoin, or two very important considerations when inspecting a stablecoin. There's a capacity to depreciate it if there's undersupply and overpeg. You got a stablecoin going around at a buck oh 04, you're off peg. The peg to the upside is extremely easy to manage. The peg keepers that Curve has, as well as like Frax type, AMOs, have authority to mint CRVUSD. So if you're at a buck oh 04, the peg keeper's like, all right, we need more supply. And you see that right here, peg keeper debt. So that creates a debt for the system. It's creating CRVUSD, taking it from 104 to 103, 102, 101, and then 100, 1. The upside peg um, departure is easy to mitigate from a conceptual standpoint. Downside is the hard one. So if people are borrowing it and selling it to buy something else, to cause appreciation of a stablecoin, you need to drive demand. That means someone's selling it into the market. Why would someone else buy it? Why would someone else hold it and not sell it? Okay, supply sinks. That's exactly what Llama Land initially was. You go over here, you're able to supply CRVUSD and allow other people to borrow it. So it's kind of uh, it's not the best supply sink because someone's using a collateral to borrow CRVUSD in order to ultimately resell it. So it's not the strongest supply sink. So what has been effective thus far is SCRVUSD. There's an interest rate associated with creating CRVUSD. So right now that interest rate is basically 15%, let's say, across the board. If you redirect a portion of that revenue to SCRVUSD deposits, that incentivizes people to buy CRVUSD, deposit it, and get the market rate. So the market rate for creating CRVUSD compared to the market rate of SCRVUSD, I'm sure Michael and folks are having a field day with this data. That's why we had a bit of an adjustment that gave more cash flow to SCRVUSD, gives the protocol more capacity to redirect capital there, and that gives it better peg control, allows it to create more of an incentive for people to buy CRVUSD in the open market. Now, what's the new protocol? Resupply. So resupply would be yet another supply sink, especially if you could provide. LP, CRVUSD, SCRVUSD LPs to mint another stablecoin. Why would that be of interest? That'll be driven by interest rate arbitrage, meaning if you're getting 10% because of what? Culmination of transaction fees as well as incentives on a CRV LP, and you're able to provide it as collateral to mint whatever the token name is going to be for resupply, um, you have an interest rate arbitrage, you have a carry trade. If you're getting 15% and the interest rate for our resupply is 10%, there's a 5% spread there. Now, none of these equations make sense with small amounts of capital, but these equations become quite exotic for large actors, which is quite a tantalizing thought for the future of total outstanding supply. If you take $1 million and you get a 5% interest rate spread, that's $50,000 a year. You take $20 million or $100 million with a 5% interest rate spread on a carry trade, it's that much more money. And those are big numbers. And that is a risk adjusted exposure to these relatively volatile markets. So if you're investing in these crypto markets and you're investing in just volatile assets, it's a completely different risk consideration than trying to get an interest rate spread. Executing a carry trade. Now, obviously, 5% doesn't sound that intriguing in the context of the risk free rate from the US government being basically 5% right about now. But that is where the future is heading, to that type of risk assessment and opportunity analysis. Let's say risk-free rate lands at 3.5% sometime next year or whatever, 2026, whatever. And you got interest rate spread for resupply, LP, and the spread is 10%. All right, 10% is quite interesting compared to a 3.5% risk-free rate from the US government. So that's just another supply sink. And that's just one component because then you also have SCRV-USD. And now you have also other stable coins. And all of these actors understand incentives, and incentives drive behavior. And Dala does crazy things with incentives. They're one of the largest vote renters on vote market. So they have their fixed rate program, and they sure as hell know how to recycle capital, paying 10%, drop in $100,000 right here, one, two, three. So this factors into the equation from a protocol perspective and how they execute business strategy. It's a biz dev type consideration. How much capital do they need? What is the effect of applying what kind of incentive? And this plays into curve valuation. It's a complex series of knock on events to really wrap your head around it. You're never going to wrap your head around it because it's a moving target. But when you understand the mechanics, you're able to at least describe them, which is exactly what I'm doing right now. You'll never be able to envision all these moving parts simultaneously, but in the end, there's one thing that really matters for a product like CRVUSD, 0.99868. That basically means the savings rate is effective at incentivizing third part or after loan purchases of CRVSD from the US of the open market, and this in turn drives down interest rates, and you get to equilibrium. So I'm sure the Fidian folks, they're all like doing these crazy ass graphs about this behavior, and like, whoa, what other supply things can we do? But we don't want interest rates to be too low. It needs to be an interest rate spread. How do we manage that? How do we keep these interest rates competitive? You want the borrow rate to be low, but when the borrow rate is too low, that affects revenue. So how do you find equilibrium? And how do you have all of these forces be governed automatically by deterministic contracts? instead of a Federal Reserve Board of white pasty dudes, because that's what nobody wants. We want the software to run the system and the software to be trusted and unchangeable. When it's unchangeable and it operates by deterministic rules, then you can begin to understand how the system behaves and you have an increasingly predictable environment as compared to what the white pasty dudes at the government do. Everything they're doing is based on subjective discretion. They're taking data from a billion analysts and they're digesting it and making a choice. Whereas the software, you can inspect the rules of the software and understand that under this market condition, this is going to happen. Under that market condition, this is going to happen. And that brings a sense of fairness to the situation. So this type of product, along with other stable coins, collectively create an ecosystem of an increasingly fair dollar system. Hope that helps. Joel, prediction. We're fucked at least until late 2025, 2026. The US dollar must maintain dominance, expensive 99%. Finding cash flow business is a great way to DCA into assets of emerging markets. Second sentence is quite reasonable, obviously. Look for discounts, look for good cash flow. Be prepared for decreasing cash flow, be prepared for devaluation, continued depreciation. What's pertinent is you bought something at a relative discount and you hope it doesn't get further discounted. Don't blow your entire stack of cash because that's the only thing that gives you a choice. And you need that capital also to as savings. You need to finance living expenses and whatnot. So that's part of the equation. How much free cash should a portfolio contain? I'm not here to give that answer, but I'm sure as hell here to say that is a very complicated conversation, especially with the spouse. In my instance, my wife. Very complicated conversation to have. How much free cash should you have? As for your forward-looking statement with your stock, um, I'll let the market tell me that. The market will scream that. You see the DXY start to roll below 107 and make a strong move towards 106, 105, 103. You'll be saying a different tune really quickly. So I'll let the market say that. And that is why I come on the stream and I talk like I do. It's not indifference, it's a sense of understanding. I don't know where the market's going to go. No one does. And from a technical analysis perspective, you got very successful traders that are able to make speculated, risk adjusted bets on up or down. It's not the game I play. I'm here to look for comfort. I'm here to buy as cheap as possible, cash flow positive fintech business, and be comfortable with it to the point where I'm like, okay, this is what the market's doing. I understand it. And what is my net inspection? How much cash did I make on a weekly basis? And by reframing this engagement or this way of engaging with these markets, I've created a much more sustainable methodology, absent anxiety. If that helps. They got to wait until March, April of the Trump administration for bold statements. Quite a reasonable response. Things change post the 20th of this month. And from a time horizon standpoint, I mean, I firmly agree. Check back post Q1. Significant changes in policy, in turning over of a presidential administration. Give it a quarter, ladies and gentlemen. That is quite a reasonable statement. Um, Time is the hardest thing for people to understand. Um, and because that's obviously clouded in this overwhelming anxiety that humans are capable of, it's very easy for me to say check back in a quarter, 3 months. Meanwhile, we all have to take our kids to school, pick them up, study with them, go to work, get a paycheck, pay how many credit card bills in a quarter? Three. So easier said than done. The mental exercise is to differentiate between personal day-to-day responsibilities and what you're able to achieve with regard to a methodology for thinking about engaging with the financial markets. Now, as a human, you're not going to be able to bifurcate. You're not going to be able to be like, all right, this is the way I think when I think about this. This is the way I think when I think about this. Everything's going to bleed over, and you're going to have that whole emotional shit show between the two ways of thinking. But at least you know. At least you've defined, I think like this for this, I think like this for this. And then the struggle of humanity is trying to bifurcate that emotional response to the methodologies that you create. My man. Connected dots. Good morning, Cap. Appreciate you. Always love the DXY and move discussion. Oh, I didn't even touch on the move. And we are at 102. So obviously we talked about long duration debt as well as the DXY, but move made a marked move upward. Back above 100, expressing volatility. So um, this nicely encapsulates probably one of the most important inspections of financial markets. You got Bitcoin going from 107 to 94. You got very different behavior as compared to Bitcoin being at between 100 and 102 for a month. The move indicator very much is expressive of uncertainty, which creates anxiety, which decreases financial activity, which decreases the tendency for someone to take on a loan. As I said, it decreases financial activity. Probably one of the best high level inspections of what the hell the market is up to. Very simple. MOVE chart. Phyllis, good morning. Always a pleasure. Tap C, what's up? Yo. Arrow. I know you mentioned voting icky for Ramses, yet those pairs have quite low volume and quite bad APRs. What to do? I vote icky Ram, icky Nile, and then Clio is just like an MF or whatever the hell is paying the most. Clio is the most underperforming of the Kingdom protocols that I own. So I don't really think about it. Like I used to try and pick the best. I used to do that and I'm done. I'm over it. I like voting for Ram and Nile, particularly because one, they support the protocol. Two, there's an icky exposure to it, which has increased returns as compared to what's it called, the legacy volatile. So that's nice. Three is not always low volume. You get some stuff like we had with Nile, and I mean, that was like a $1,500 a week. That was crazy. Um, so that's just a consideration. Supports the protocol. Concentrate exposure via icky rather than legacy volatile, and it works. It pays relative market activity. Obviously, if transaction volumes decaying on Arbitrum and Linnea, it is what it is. So it's going to be a fair market rate of return. Um, Probably very comparable to trying to optimize it. I don't care about 10, 15, probably even 20, 25% differential between trying to max it out versus, all right, I'm going to get what I'm going to get for the icky Ram LPs. And that's good enough for me. Nowadays, my mind is much more on the business structure and documentation and family and pulling away from the computer and focusing on these types of thoughts of how to reduce anxiety and just continue to gauge with the market sustainably. To me, that's much more important nowadays. It's almost as if what to buy or what we own has become a relatively small part of the equation. Because you have to remember, in the context of where everything's heading, everything is likely heading to be significantly appreciated over the next 4 years. I think the amount of stablecoins in the market is going to go down. These protocols are going to be used less. So it basically means it's consistent with what I talked about earlier with the immutable contracts. While these contracts aren't necessarily immutable, therefore they have a different risk profile. These protocols are existing and functioning. What's the point in thinking of the day to day? So the only inspection that matters is how much cash you get on a weekly basis, tracking that from an accounting standpoint, and then you measure month over month revenue. Less revenue, austerity. More revenue, prosperity. You adjust your life based on the amount of capital you get from work. You get fired, you got to spend less money. If you get a raise, you can spend more money. So that's the same exact perspective I have on our cash flow. That helps. Killers. Understand the mechanics. This resonates. If I accomplish this, it's easy to make decisions for whatever scenario I'm facing without having to keep referring to some specific template. Mechanics are everything. It's the interconnectedness of everything. This causes this, that causes that, knock on effects. Now, you never, as I said, be able to have, a holistic capacity to digest everything that's going on in real time, which is why I love DXY, Move, and just the 10-year treasury, because that gives me enough high level to be like, all right, these are the forces that are driving markets. Therefore, this is what I could expect in the short mid term. And then I do what the only thing is to do, manage the emotional response associated with that reality. But everything else continues. Accounting must continue, legal work must continue, family must continue. So those are the important things. The volatility becomes irrelevant. And what to own? I mean, we've refined it to, frankly, that's maybe an interesting segue. Oh, wrong one. This one. Spectra and an AWA. Yeah. Didn't I have a third line? I had a third line. Let's see if it hits here. Horizontal line. Something like that. So clearly this level is invalidated. That is basically a resistance holding as resistance. It retested, rejected once or rejected twice. This is 1 hour charts, relatively new asset. Unless the market just does a fat wick to the upside and we all of a sudden flip bullish, directionality will prevail, and this is a big topping. We will move to lower levels. Oh, there was the third line, but it was much lower. So you got 1, 2, 3 lower levels. This is probably a decent level of support. We'll see. Maybe it's not, but the market will tell you. So this is probably the only thing I've been wrestling with the wife about, the Spectra position. Obviously, we have to take a decent size. So position size is very much a part of the conversation. So unless this significantly depreciates from here, I can't justify a position necessarily. I'm not too fond of the vast majority of emissions, or rather the gauge vote incentives being Spectra denominated. I wish there was more of third-party involvement, but it's not there. So I am hesitant. Hesitant, one, because it's just redundant exposure to the Curve ecosystem. Clearly, I am quite fond of the protocol because it's an SCRVUSD and an S money supply sync. But if you go here, it's 9 grand, 9 grand in dollars. That's pretty cool. Spectra, 4 grand in dollars. Spectra, mostly Spectra incentives. Eh, What's that going to cause? That's going to cause depreciation. So that just further substantiates the inspection that there's probably more depreciation likely, and this is a topic. Um, I'd like it to go up, and I don't give a crap if I have a bag or not. What's pertinent is it contributes to the bags indirectly, vis-a-vis the supply sync functionality. That's the effect it has on the market. Heck of a protocol. And if we get lucky enough for a decent price where an appropriate position size can be attained with an available amount of capital, so be it. So be it, because I would have some splaining to do to the wife. Let's take a look at AWA real quick. Why not? They're throwing around a lot of AWA. They had obviously the launches on sexes. So this was a big retrace, massive retrace. But there's a couple of interesting levels from a technical standpoint. Expression of support, clear as day. Expression of support, it falls through. What's the cash flow on AWA compared to Spectra? Spectra's, 30%, let's say. Expect appreciation of that because obviously as Spectra price comes down, these rewards will come down. So it's not necessary. So here's your Z component. What's the likelihood the cash flow is going to continue? It'll probably dry up in the short term. This is not the most optimistic situation for cash flow to be sustainable. AWA, go over to exchange, bridge. 21%. Frankly, I don't know whether it's AWA denominated or revenue denominated stablecoins, transaction fees. So that's something that is a due diligent requirement. Frankly, honestly, for both of them, I'm just like, I don't need anything. I don't need any more. There's nothing to buy. Everything's reasonably sized with regard to position size, and everything else is a stretch. The most important thing in these markets is don't force positions, don't force ownership. It needs to be an appropriate position size. It needs to be critical mass. Because if it's going to Z, stop paying, excuse me, even for a short transitory period of time, that's relevant to the equation. Um, can't just throw darts at a dartboard. This isn't meme coin trading. This is a sophisticated process, and we are sophisticated investors. So we need to have extensive rationale in this decision-making process. So these are probably my two favorite protocols right now that I don't own, but I don't see conditions saying to me that I want to own them. And it's a stretch. And when the market makes you stretch, you need to listen and probably restrain yourself. That helps. Going to Botas. Hi, Cap. Quick question. How do you explain to a TradFi guy that passive income businesses also exist on chain? Probably never be able to. Uh, you can show him if I Lama. I mean, you could show him fees and revenue, but let's see if that shows what something that I would look at. No, it doesn't, and that's exactly something that's meaningful to say. You can show him tether fees. What does that mean? You can't invest in it. None of this is investable from a cash flow standpoint. Uniswap, it's uninvestable. So, all right, there you go. So you would literally have to pick out and also explain what is and is not investable, and then you have to explain the reasons why. Like Aerodrome, there you go. That $1 million in 24-hour fees, and that all gets paid, all of it. 100% of that $1 million gets paid to people, not a dividend rate set by a white pasty board. All of that money gets paid out. That's pretty crazy. But look at that. Now you literally have to piecemeal the information and give an entire story about why the hell the rest of it is stupid from that perspective. In consideration of what is passive income, what is traditionally called the dividend stock. You can go over to volumes, but then you're going to have to explain, hey, look at that, positive week over week volume. You'd have to break it down like the volume's 517 mil, and then you could explain on curve, and then you can explain 0.04% of min fees, and you can break it down 0.02% goes to us, 0.02% goes to the Dow, and then you have to explain CRVUSD and dollar liability. To literally understand stablecoin, you have to understand dollars. And to understand the stablecoin is more than dollars because now you have to understand the mechanics that I explained earlier about peg stability and why it's actually investable aside from the potential cash flow from the investment. You see, here's the thing about TradFi. It's kind of like, am I supposed to say? It's like sixth grade education. I'm gonna buy shares of Coca-Cola and it's gonna pay me a dividend. I'm sorry. I'm sorry. I'm sorry. It's literally that's like it's not a coloring book, but it's a Goosebumps novel or something. Something that is not sophisticated. There's nothing sophisticated about dividend stocks. It's gonna pay you a dividend. Oh man, REITs and stuff. It's just this stuff is so damn interesting compared to dividend stocks. This stuff is technologically enthralling. We're literally talking about the creation of dollars and banking and forex markets. And then you have to understand why these are businesses, you literally have to describe what the hell a forex market is. A TradFi dividend investor is not going to understand what the hell a forex market is, maybe unless they're a forex trader, but then they're going to understand cross currency pairs and they're going to understand it from their perspective. They're not going to understand what happens if, how does the bank operate a forex market? What kind of who's providing the dollars? Is it just the bank's dollars, or are they accepting, high net worth individual capital? And what's the revenue sharing agreements? Where's the cash flow come from? They're not going to understand these types of conversations unless you explain them. So I don't know how to explain it other than literally what I'm doing right now in storytelling format. This is literally what I do and have done for years is just tell the story. And the thing is, it's the same story over and over again in many regards. It just gets refined, refined, refined to the point where we're having this specific conversation today. That's how you explain what we do to TradFi guys. You tell a story, and you could lead a horse to water, but you can't make them drink. They'll only listen if they want to listen. You know how many TradFi folks I've talked to? They're like, I'm going to stick with what I understand and what I know. So be it. That horse doesn't want to drink. Diego, hola, hola, buena tarde, ¿cómo vamos? Great volatility these days. Yeah, should be good volume. I expect some nice cash flow. Where we're at, we'll see in a second. Okay, okay, dokie. I don't know why it's not loading, but whatever. CRBUSD. Not, let's see. Total. No, I'm not looking at what I want to look at. It's how much these CRUSD earned this week. Last I saw from social media, it was like 600 grand. That's pretty nice. It'd be a nice week. Great volatility. Yes, indeed. Hugo, good morning. Hope everything's good. Without a concept, Cap, can you explain how the votes work on Ramsey's? Only the highest total votes rewards go to people who cast it to the pool. So votes in solidly dexes, the voters get all transaction fees, and the LPs get Ramsey's incentives. So when you vote, you are these numbers reward estimate is based on the previous week. So you're not going to want to sort by revenue because look at these rewards, $2. And it might be $2.35 per thousand votes, but there's total $2 to shell out. So you can get complicated and look at total rewards. Wow, these rewards are significantly down. I remember these being at like 30, 40, 50, 60 grand. So if you depends on your voting size, you got a million V RAM, you're going to get paid 12 cents per vote. And last week's rewards were $5,675. So you get your pro rata share of that um, Pro rata meaning, a million RAM and there's 400, 46 million votes, you get 1/46th of it. Okay, so that's a simple way to see, because aside from looking at reward estimate, if you're voting with a mill and there's 46 million votes, you're going to get 1/46th of this total revenue share. And bear in mind, this is a projected revenue share because this is based on last week. So for Arrow, you go over to Icky, these numbers are based on last week, but if you have a RAM spike and there's 20 grand worth of rewards, well, you get your pro rata share. So that's why when Ramsey spikes and Nile spikes, it's like, ooh, okay. So when that week when we had Velodrome spike, that was nice. I hope that helps. It's probably not the best explanation, but we'll keep it short. Window shopping, any VE NFTs on OpenX? Probably not. Have enough exposure. That's one of the hardest things to do with capital management. When is it enough? When do you have enough exposure? When are you overexposing, over concentrating? I don't know. It's not for me to answer those questions. 73% priced in Velo, 27% discount. No, 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 no. I'm saving my capital, wife's orders, unless there's like an extraordinary circumstance, like 50% discount, priced in USC, and Velo has collapsed to 10 cents. Then I'd be like, honey, we got to talk. So that's probably where I'm at with capital management and like potential acquisition, unless it's like a hell of a deal. So you can only imagine, what the hell is Warren Buffett waiting for? He must be waiting for. I just think about that all the time. What do you do with all those hundreds of billions of dollars? He's waiting for like someone help buy us. We're about to fail. You could buy us for 20 cents on the dollar, 80% discount. Hostile takeovers. That is what he's waiting for. He's waiting to be a shark and to completely tear apart some prey. So I'll never be that. No, none of us will ever be that. But we could sure as hell be like, oh, I understand. And I'm going to try that. And that makes that interesting. So as of right now, nope, 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 nope. Money depeg, yes, indeedy, just a bit. Dollars collapsed. Not that. This. No, that's the portfolio monitor. Is it offline? No. So base is right on peg. It's not a horrible depeg. Optimism is 989, so you're at nine. You're basically at 99 cents in a relatively low volume situation. It's literally 561,000 money. This is not. It's not clearly not critical mass protocol right now. You're at just people playing around with it, which is interesting. That gives them a lot of latitude to continue iteration, work on biz dev. Um, this is a very low consumed situation for the protocol. So that's interesting. I'm sure they're all talking right now. What the hell are we going to do about arbitrage bots using their new AI? Is it financially reasonable? Because the arbitrage has to be at least net positive, otherwise you're spending capital. They're probably working on collateral arbitrage to work on these interest rates, because this is saying repay. That's what a high interest rate is doing. It's saying just pay your shit back because the protocol needs to trigger the price appreciation. But the interest rates are more palatable. Was that optimism? And clearly on base, you're on peg. You're at a dollar. So you notice as you're depegged to the downside, the way you trigger repeg is to force people to repay. And you force people to repay by increasing interest rates, saying, ooh, ow, I can't take it anymore. Okay, fine. I'm going to buy money and repay my debt. It depegged to the downside, but there's how much collateral, 2.4 mil worth of collateral that this will be peg in 5 seconds flat if people want their 2.4 mil worth of collateral. They're just like, all right, buy it from the open market, buy money and repegs, and they take their collateral. So more so in this situation because of how relatively nascent the protocol is, just starting out. Um, this causes collateral melting. So a DPEG like this, you'll start to see this go from 2.4. People start to repay. It repegs, and you're at 2.2, 2.1, 2 mil, stuff like that. This causes much less collateral melting than a DPEG for a redemption model, because the redemption model doesn't give the optionality of the interest rate. The interest rate just encourages people to repay. Maybe the person doesn't care about 30%. Sure, they care about the 300%, but maybe they don't for a week. Maybe they're like, all right, this will stabilize. But when it's a redemption model, it's like, all right, done, cut off, redeemed. So that's a bit of a calculation. In that regard, I'm curious how Liquidity V2 is going to play out. I'm sure they've thought of that. I'm sure that's exactly what they've talked about in their V2 docs. Um, you know, the man, is it the managers, the managers that manage how close uh, uh, a debt is to liquidation. So, all right, we'll see how that plays out. So, 2 cents on liquidity is untested. Great, novel, cool. Technology, interesting. Dollar liabilities. We'll see what the market does, because the market will tell us what the hell it thinks and how well it's received. Simple as that. I'm much more interested in protocols like this as compared to redemption models. The interest rates give at least optionality. You don't get gamed. And to top it all off, you literally have soft liquidation because this is CRVUSD. So much more interested in these types of protocols at minimum because they mimic traditional finance, which is something that the brain can wrap your head around. If there's low interest rates, all right, I'm not going to repay. I don't give a crap if it's 1% interest rates. And then if it's 30% interest rates, you're like, how long can I take this for? Should I repay? And you're like, well, all right, fine. So it's 30%. In a week, it'll be 5%. So that's the optionality that variable interest rates afford. I much prefer variable interest rate CDP stablecoin design. We're going to wrap it up for today, Wednesday, January 8th, 12:43 p.m. I appreciate all of you for joining me for this rational conversation. 364 people made it to the end of the stream, and you are now that much more rational because of it. Be well, stay calm. Markets will drive folks mad, and try and think about things a little bit differently. Rewind, replay this video if you need to find a little bit of comfort. I'll be around later this week. I'll be on social media. Until then, peace.